Good afternoon. My name's Ken Gryske. I'm with Marcum CPAs. I wanted to welcome you all to the Reg A Plus, cutting through the clutter. How many people here have heard of Reg A Plus? And everyone can hear me fine? Okay. How many people have been engaged with deals or are thinking about a Reg A Plus type filing? None? Yes, maybe? Okay, well, good. Oh, hey, there's the presentations right here. Well, welcome. Listen, there's two things here. We're going to just briefly go over the ins and outs of Reg A Plus, the what is it, and then we're going to talk, you guys should be thinking, hey, is this something that I should be looking into? And we could not have a better panel to answer any questions about Reg A Plus, and if they don't have the answer, by God, we'll get it. Let's see here, questions. There will be an interactive session, so there'll be a lot of questions and answers, and we'll make sure that everyone gets heard. I'm trying to read my writing. I know we'll cover a lot of things, but we're also going to cover, you know, the 530 exemption, but we'll talk about that later. So with that, I guess it's this button, Reg A Plus, cutting through the clutter. We're going to try to make things a little bit more clear for you. Okay, I'm done. Thank you. Good night. Okay, no, okay. Let me introduce the panelists really quick. We have Andrea Cataneo from
Sichenzia, Ross, Friedman, Ference.
Thank you. Wow. And we have Maggie from Maggie Chou from the OTC markets. Steve Rapatoni from Marcum. He's an audit partner and SEC auditor. James Riggs is an investment banker and in charge of investment banking for Moloney Securities. And Goran Ruckdeschel he's the vice president of operations from Vintage. And with that, I'm going to introduce Andrea, and okay, there's our beautiful selves. And now let's do just an overview of what Reg A Plus is. Andrea, take it away.
Where's our Reg A music?
There's no Reg A music.
He's going to get the guitar out.
Sorry, this was going to be much more entertaining. So a lot of you know about Reg A already. What I'm going to do is just take a few minutes, since we only have a half hour, and go over just some of the basics and the mechanics, and this will make it maybe a little bit easier to ask questions that come to mind. So fairly recently, just this past June, the SEC adopted final rules under Title IV of the Jobs Act to facilitate capital formation for smaller companies. And it was sort of a long overdue improvement of the old Reg A that was really underutilized. And when I say underutilized, I'm not exaggerating. I believe if my statistics are right in my research, I believe from 2012 to 2014, there were only 26 that were filed. Only 26 companies relied on Reg A as an exemption and filed them with the SEC, raising less than $60 million. Now, just to put that into perspective, if you just look at 2014 alone, over 11,000 Reg D filings were completed for over $1 trillion. So Reg A really wasn't used very much. Why? Because it had problems, because it had some issues. It seemed like a great idea. You could raise money, you could, raise $5 million and have free trading shares. It all sounds good, but the issues really were the maximum raise was $5 million. It was only available to accredited investors. The review process was very long, and I'll get into some of that later. Not much later, don't worry. It was over 300 days on average was the review period, but I think the worst part of all was the blue sky compliance, and that's not merely making a notice filing like you would do with a Reg D. That was essentially providing the states where investors resided with a copy of the prospectus, and often they didn't like the format it was in, so you'd have to reposition it, give them what they wanted, they'd give you comments. You were almost going through a mini registration statement in every state where investors resided, making it way too expensive and difficult to utilize. So it just really didn't get used that much. I would move to the next slide, but I don't know how.
It's a big green button.
Did you like my transition, though, with the little puzzly thing? That was mine. Okay, so who's eligible? U.S. companies, Canadian companies that are private, that are not reporting to the SEC. Ineligible issuers I have listed up here, there are a lot of them. If you're a blank check company, you're ineligible. A SPAC is ineligible. Issuers of fractional interests in oil and gas and similar companies. We haven't come across this yet, but prior Reg A filers, Reg A Plus filers that weren't compliant in their filings. The reason we don't have many of them yet is it's pretty early in the game. Bad actors, et cetera. Eligible securities, equity securities including warrants, debt securities, and securities convertible into or exchangeable into equity securities, including guarantees of such securities. Asset-backed securities are not eligible. One little tidbit, you might find this interesting if you're a service provider and you're willing to accept shares as part of your fee. You can accept Reg A shares and they're not going to lose their free trading status. Anyone who knows me knows that. I like that information. Okay, next slide. There we go. Okay. 2 tiers. You're probably somewhat familiar with the 2 tiers. If not, I will summarize briefly. Tier 1 is up to $20 million over a 12-month period with a limitation on affiliate resales of no more than $6 million and no more than 30% of selling security holders can be resold. Kind of reminded me a little bit of Rule 415 when you think about you could only register 30% of the float. It's kind of along those lines that we believe the regulators came up with that. The problem with Tier 1 is there's zero relief from blue sky filing requirements, zero. And that's not the SEC's fault. It's not the Jobs Act author's fault. It's really the states that essentially fought. If anyone was kind of reading what was going on with the proposed rules, the SEC wanted this all lifted. So Reg A could be terrific. And it is terrific for Tier 2. For Tier 1, not so much. You have to go through all of that same headache of getting not only the SEC to approve it, but to have the states approve it as well. Tier 2, up to $50 million in a 12-month period, with a limitation on affiliate resales of no more than $15 million, and also no more than 30% in total for all selling security holders. Really limited state notification, piece of cake, notice filing, a check, not a big deal. There is a non-public review available. I think it's worth mentioning, because if you read about Reg A+, it talks a lot about filing with Edgar and being out there in the open. If you want a non-public review, you can have one. You've got to ask for it, and a lot of companies prefer to keep things kind of quiet while they're in the drafting and reviewing phase, but they do have to expose everything towards the end, 21 days before it goes effective, and that's when everything gets revealed. I think a lot of clients would prefer that, but it's really, it's available, and that's really what's important, is it's available. Okay.
Green button. The rank.
It's not on here. Oh, there. It worked last time when I touched it. Okay, content requirements. It's very similar to requirements for a registration statement. One thing that's different, that's really distinguishable here, is audited financial statements are only required for Tier 2, and they don't have to be audited by a PCAOB accounting firm. It doesn't have to be a PCAOB registered firm, so it's going to be a little less expensive. That's a good thing. All of these other items, they're quite familiar. These are the types of things you'd see in a private offering document or in a registration statement. I did it. All right, satisfying concerns of investor protection. Tier 2 has some additional requirements for up to $50 million. Like I said a moment ago, audited financial statements, but they don't have to be PCAOB registered. There is an investment limitation for non-accredited investors, and we'll talk a little bit about that. I'm sure you'll have some questions about how non-accredited investors could get involved in Reg A Pluses, but the protection here is they can't spend more, or they can't invest more than the greater of 10% of their net worth, or annual income or net worth. It's the greater of, and that's as determined by Rule 501 of Reg D. That's probably good. You don't want anyone parting with their kids' college tuition and then some. But you can attract the crowd with Reg A+. You can get lots of non-accredited investors involved. There is ongoing disclosure requirements. If you choose to be reporting all of this on the grid, which a lot of issuers or a lot of private companies are going to decide to do, there's a 1K, all these new names of forms you'll explore later on when you have to, but The 1K is really going to be an update. The 1SA is similar to a 10Q, and then there's the 1U that's kind of modeled after the 8K. So there's going to be certainly the ability to communicate to the public that things are being kept up to date. Integration, a lot of people are concerned about that. Hey, how are we going to raise money while we're waiting for this Reg A Plus to get approved? There are a lot of things listed here, a lot of different offerings that are listed that would not be subject to integration, but a Reg D offering would be. So you can't have a Reg D offering running at the same time. You can raise money overseas, you can take in bridge financing, and in my opinion, based on really not a lot of data yet, because there have only been about 23 or 24 Reg A pluses that have been filed so far, I believe the review period is going to be way less than 300 days that it was with old Reg A. Why? Because law firms and experts that are used to filing registration statements are going to be more involved, and it's very similar information. So that long lag, I don't think, is going to stay. A lot of people ask me about Rule 144. How does that impact, or how is Reg A, how are Reg A shares impacted by Rule 144? Reg A and Reg A Plus, they're exemptions from registration. So Rule 144 really does not come into play. They're not restricted securities unless we're talking about resales of people who, resales by affiliates, and then those shares are subject to limitations, just like everywhere else, 1% of the issued and outstanding every 90 days. Tier 2, however, must file its semi-annual reports and voluntarily file Q-like information, quarterly information, but it's not called the same thing, on a Form U2, and it has to do that to satisfy the current reporting requirements. So I guess there is a sort of quasi-Rule 144 analysis in place. You need to have current information if you want your securities easily sold. I just have a few initial impressions, and then I'll give it up to the questions, and I'll let my esteemed colleagues answer questions. I think Tier 1 is a real disappointment. I think a lot of companies, since they're going to have that burden, will opt not to bother with Reg A Plus if they're going to be raising less than $20 million. I didn't put it in the slide, but I think there's some flexibility if we talk about companies that are seeking to raise close to $20 million. If you think you could put $15, $17 million to work, perhaps you ought to write your prospectus for $22 million. Get it through the Q&A, get it through the comment phase, and raise your money. The states are not likely, you're not as at risk at that point, having the states come back and say, hold on a second, we want to take a look at that again. If you're not close to 15 million that you actually need, that you would close on, I think you're running more of a risk. Don't use Reg A Plus. You're probably going to be able to seek other methods, I think, more easily than going through that expensive process. There's presently no established secondary market for Reg A Plus. It's like, hey, we got free trading shares, yippee, what do we do with them? I actually met someone a little bit earlier today who you should all speak with, named Blaine McLaughlin from Folio Investing, one of the first people I've spoken with who's got a clearing firm for private companies, for Reg A securities. So there are potential outlets. But generally speaking, you're going to have to go public. You're going to have to become reporting. Good news is, to become reporting now with Reg A Plus, you file an 8A. You don't have to go through a Form 10 or an S1 like you had to with regular old Reg A. An 8A is a very simple, almost not reviewed, almost never reviewed form, so it's a nice transition. While seemingly, I say, costly and time-consuming, I think Reg A Plus can also defer a lot of the costs of being public for a company that's looking to raise capital. So I'm in favor of pursuing more Reg A Pluses for companies that don't want to expose themselves completely to being reporting. There is a test the waters ability that we'll talk a little bit about, I'm sure, in the Q&A. So that's it for now. I've taken up enough of our time, and feel free to ask questions.
Yeah, thank you, Andrea. Okay, there we go. Let's get back up.
Oh, by the way, that's some good information if anyone's interested. Those are really helpful links. I could send it to anyone who lets me know they're interested.
Okay. And we can get this on the NIBA website if they like. Okay, here's the panel. What I'd like to do is one thing, is just to remind you that there's going to be we're in between you and a cocktail party. We understand that, but this is kind of important too. It's a daunting task, but please take the opportunity to drag these guys offline and ask any additional questions. But right now, I want to ask Maggie. Maggie, what kind of questions are you getting about Reg A Plus, just in general?
Hi. So actually, I wanted to just kind of clarify one thing. Reg A Plus deals, while there has not been a market created specifically for them, they can trade on our marketplace in a way that any security now trades, sort of on the OTC market. So instead of going through what we typically see as someone does a Reg D and then they wait for the restriction to be kind of lifted and then go under 144, or they file a registration statement, these shares are freely tradable on day one. So a market maker can you hear me?
Yeah.
Oh, a market maker can file what they do now, a 15C211 for a Reg A Plus deal after the offering has been completed. So one of the questions I've been getting is, how is Reg A Plus different from what companies are doing now? I can't fix.
No.
I think someone waving at me.
So that means that it will trade as a pink sheet, right?
No, actually, so we changed our rules specifically. So, there's been talk about Reg A Plus being equity crowdfunding. There's it goes through a pretty similar process, of SEC review, and there is financial information out there. So Tier 2 offering has annual audit financial statements. They have to file semi-annual reports. Those timelines are a little more lenient for Reg A Plus issuers, and they can trade on our OTCQB and OTCQX marketplace. They do have to do a little bit more to be on OTCQX. We have quarterly financial requirements for purposes of 144, and just making sure investors have information out there. But we've structured and changed, adapted our rules to fit within the regime of Reg A Plus. So these offerings, we're going to take advantage of the fact that these are freely tradable. The blue sky on initial offering, is non-existent for a Tier 1 offering, a Tier 2 offering, and also the nature of a Reg A Plus. These are deals that can be upwards of 50 million, which means that that's a lot of capital, and a lot of companies that can utilize Reg A Plus are those of consumer type companies that have a social media presence, that have a product to sell, and what they can do is really go out to their client base. So we see a lot of these deals that have a big retail presence, a lot of individual investors that are going to be wanting and seeking liquidity, compared to other offerings that are going to have restrictions and that are held by maybe more institutions than not.
Okay, thank you, Maggie. Could you pass it over to Jim? I'm going to pass over my colleague for a second. Jim, what is the perfect Reg A Plus deal look like? What if you can just kind of spitball, hey, just take me through the process.
So if I may, I'm going to take you through the process.
Yeah.
I'm trying to keep this quick and as brief as my resume and hopefully to the point. Can you hear me now?
Yeah, you got to talk right in that.
How about that?
There you go.
First thing I'd like to point out is I think begin with the end in mind is a nice place to start. These are complex transactions collectively. And I see a lot of them where people come to us, Moloney Securities, we have 140 reps, 34 offices around the country, and they say, will you help us sell our Reg A? And the short answer is no, because we haven't been involved in the process, to Ken's point. So I'm going to very quickly take you through a process. And of those of you who are considering, know that we'd love to co-manage with you, and we've been through this process. We know how to get these done. And the first one we did, we got everything but DTC eligibility, and now people tell me that the DTC has demonstrated that they're willing to work now that the rules have been promulgated, and we're in the go mode here. We've got a $50 million one filed presently, and much more to come. So I want to thank you guys for being here, my esteemed colleagues here. So begin with the end in mind, I think, is a good place. And I'll take you through a term sheet, because this is where there's a disconnect a lot of times. You really should begin with a valuation, or at least a calculation, so you know the firm you're dealing with is in reality. And you can negotiate. It doesn't cost them a lot of money, and you can see then what type of security it is you wish to build. We then want to engage issuers counsel. We want firms that are going to work with us to have issuers counsel. And we have underwriters counsel at Moloney, where we then talk about the fees, the expenses, the warrants, the marketing material. Here we have people that are able to do, very experienced people like former BB&T employees and people like this who are very experienced at doing pitch books. So you can get this out to thousands of reps, RIAs. They can quickly understand this, see what it means. Access equal delivery with the 1A, the offering circular. So you're not shipping, millions or hundreds of thousands or whatever, hundreds of pounds of paper around. You require audited financials according with SEC compliance. You want appropriate opinion from issuers counsel, usually a 10b-5 opinion. A comfort and consent letter from issuers counsel, no adverse change in capital markets, due diligence. We like an exclusive contract for 18 months, and that would be with you if you're our partners to the broker-dealer community. Now, this is a point I really wanted to get to, because OTC, Cromwell, and these guys have been following this for quite a while, and it doesn't have to go on the pinks. But there are also venues out there for alternative exchanges where you can park these securities while they mature. So, if you go on the OTC and you get shorted, it could be a bad thing, okay, while these companies are growing. So there are venues out there where you can park these securities, still have your, periodic trading, and then at a later date lift up to the OTC or the NASDAQ when these companies are really ready. And we think that's going to be a feature that's used quite a bit. As Andrea said, upon issuance, you've got 50-state blue sky with a Title IV Tier 2 Reg A Plus. I like to call these micro IPOs, and it's a reemergence of Main Street, if you will. So if there's a dividend, some companies don't have that, but if you do, you can build a security that's very desirable in the marketplace. We've got some coming out. It'll be a $10 stock probably upon issuance. It's got a 7% coupon. Think about that. If it drops to 8, correct me if I misspeak, it's like an 8.75 would be the yield on that. So a lot of times you begin with the end in mind too about the life expectancy of these securities. Can you put them back to the issuer, et cetera? So to your point, Ken, you see a lot of guys that want to go do something. That, in my mind, is not a good Reg A candidate. What we like are guys that are doing things and they want to avail themselves of the capital markets at a less onerous path with lower cost. So you want to see companies that have a balance sheet and an income statement, not guys that are going to have that, okay? Third-party due diligence reports are helpful, sales period, quiet period, escrow agent, QSIP, as I said, DTC, and that's pretty much it. So you take these people through this process, and by the time they clear this, it's like special forces training. And I mean, we say no to a lot of people, but the ones that we get behind, they're vetted by the SEC. It's quite an accomplishment. And another thing you're starting to see where you were talking about large companies that have a lot of people, I think you're going to see affinity groups, because you give me an affinity, a malady, and I'll give you an affinity group. So if you give somebody that can fit in that category, they're going to hope readily, I won't say easily, but readily be able to raise money. And again, Andrea can give you the exact rules, but it's something like 10% of your income you can be invested in this. So this is legislation for the masses. You're going to have some RIAs and wealthy individuals that wish to be in this. I've had talks with guys at Goldman Sachs, not that they need us, of course, but they're interested in things like this. So a lot of your blue chip companies are not going to grow at X next year. Some of these small companies will. If you lived in the UK or Canada, you're a wealthy individual, probably a small percentage of your portfolio would be in these more risky issues. I think you're going to see the same thing here. So it's an exciting time.
Okay, thank you. So start with the end in mind. I like that. Gordon, if you could give me maybe the top 3 tips that you could do to make the Edgar filing more efficient. And just go ahead.
Yeah, sure, that's fine. I'd also like to talk a bit about the market statistics from what we've seen so far. So it's not really that different from a registered offering in terms of getting ready for the filing. Specifically, if it's a company that hasn't done anything with the SEC before, you want to make sure that you apply for your filing codes in advance. Not a very difficult process, but once the form is filled out, it needs to be notarized, and it's going to take at least a day or 2 to get those codes, and try as we might, the SEC will not budge off of that. Additionally, gathering any exhibits that are needed for the initial filing, getting them ready as soon as you can, and preferably in Word formats to make that conversion simpler. And then, as Andrea mentioned before, you do have the ability to do that draft offering statement, and the important thing to remember there is, just like on the registered side, where you can't start a roadshow for 3 weeks after you have publicly put your draft registration statement out, it's the same on the Reg A Plus side. The SEC will not qualify your offering until 3 weeks after everything is out there and public.
Okay, thank you.
And then
Go, please.
additionally, just to quickly update on the statistics, as Andrea was saying before, if there were 26 filings over the last few years, what we've seen to date, and this is since June 19th, which was the first day, there have been 29 initial Reg A Plus filings. And the interesting thing is they actually split about half and half between Tier 1 and Tier 2 that have been done so far. Yeah. And additionally, there were 7 companies that had started the paper process, and then they switched over to the new electronic process. And industry-wide, it's been about, between 600 and 650 million that people are looking to raise through these initial offerings. So not the $1 trillion mark, but it's getting
Not
there.
with the T.
Yeah.
Go ahead.
That's an excellent point. May I make one point, which Maggie, but Cromwell Coulson said this before I did. This is, you're taking laws from the 30s and you're updating them to the 2015. So you recognize things like Edgar, the internet, and that's what's happening here. And so this is not a new thing. It's an old thing refurbished.
I like it. Hey, oh, go ahead.
And just additionally on the Tier 1 side, so what we're seeing is Tier 1 issuers are looking to raise about 75% of the maximum, so really right around that Andrea's number of 15 million, although it does vary quite significantly from about $500,000 on the low end up to the max of 20 million. On the Tier 2 side, we're seeing an average of 60%, so I guess 30 million out of the 50 million. It's a little bit trickier to track the confidential filings because they're confidential for a reason, but we do have ways to kind of see what's happening. So to date, there have been 16 initial draft confidential filings, of which 3 have progressed to the public side. So there's still 13 out there. Whether or not they will progress and move forward remains to be seen. So what we're seeing is a total of 49 when you do all the math, Reg A Plus filings to date in just under 4 months. So if we maintain that, we're looking at about 150 that we're on pace for in a year. The SEC had said in their final rule when they did their analysis, they were expecting 250. So we'll see if it ramps up from where we're at. Additionally, 3 have been qualified by the SEC, and again, interestingly, all Tier 1, which may be related to the fact that the states are reviewing or they're smaller offerings. I'll leave that to my panelists to talk about. And 2 of those had started in the paper process, and the 3rd was a bank merger.
Okay. Hey, Steve, I have a question here. You are right in the middle. What of doing one of these Reg A Plus Tier 2 filings? When you're doing the audit, are you seeing anything materially different than if you were just doing an S1 filing and then doing in the audit?
Well, I'd say, again, I haven't seen any Tier 1 filings yet, and I actually had a question before I answer that.
Sure, go ahead.
Are you seeing any Tier 2 filings under 20 million because of the issues they're having with Tier 1?
Yes, I believe there have been some under.
Yeah.
I believe there have been a few under 20.
Okay.
So on the reporting requirements, again, for a Tier 2, you're required to have audited statements, and it doesn't need to be a PCAOB firm. You're required to have semi-annually reviewed statements and an annual audit after that. So, you're still required to have your auditors involved, but it's not going to be as difficult as going through an S1 or through some of the regulatory issues that you have from that standpoint.
Okay, thank you. Any questions out there? Yes, please.
Okay, so actually this is a couple of questions.
Uh-oh.
Well, one is a statement. It sounds as if there are no minis, and you're either maximum at 20 on Tier 1 or maximum at 50 on Tier 2. Is that correct?
Who wants to answer?
Okay, the answer is maximum 20 on Tier 1 and 50 on Tier 2.
No minimum.
So
With no minimum.
there may be some minimums on the numbers that we were looking at were what the max offerings were that people were looking for on each. However, the max was significantly lower than 20 million and 50 million on several of the filings. And I think there were, in fact, more than half are seeking less than the max.
Interesting. It's just the regime, it's the regime you're going to have to follow to file.
There's one that's been filed that's for under $1 million, so there hasn't been anything specifically stated by the SEC about offering minimum. But the fact that they still have to go through a pretty robust review process, I can't imagine any company going through the sort of the 1A filing. So the 1A is kind of a hybrid of a private placement memo and really an S1, and also engaging the legal counsel to do anything less than $1 million.
Okay, and the second question in that same vein is if you file for a $50 million tier 2 and you go through all of your accounting and you fail to get even 20 million, how does that affect anything?
Okay, so I'm repeating the question here for the tape. If you file a tier 2 and you fail to get, do you say 20 million?
And you fail to get even 20 million,
Even 20 million, what are the ramifications of that?
if there are any.
There's really no data yet. I mean, I mentioned something a little bit earlier about if you're close, you're probably not going to have an issue, just based on my experience for 20 years in the industry and knowing how the SEC pays attention to some things rather than others. I can't imagine that if it's, very close, that it's going to open up a state review after the fact. That said, there's no real data yet because there are only 3, I think, that have gone effective since the rule was amended in June. So we don't really have a whole lot to look at. So if you can't put 20 million to work or you can't raise $20 million and you're relegated to tier 1, you may want to re-examine it. It's going to be costly, time-consuming, and the state review is really what's going to increase the legal fees and all of the other issues associated with the time you're wasting trying to get your company money.
Well, the point was, you want the states not to have to review.
Right.
And you don't mind doing the audits, but my question actually was, if you don't get over $20 million, say you end up with $10 million, the company can still move forward with $10 million.
That's correct.
How does that affect? It doesn't affect anything.
So tier 2 is from essentially 0 to 50 million. Any company can do a tier 2. And if you don't complete your offering, I mean, it's like someone going out and saying, we're going to do a 20 million private placement, but they only place 10.
Right.
There's no difference. And these offerings can be continuous, so you don't have to raise all 20 million at that time. You can do so over the next 12 months.
Yeah.
Another aspect of that is that when you see a lot of these banks, investment banks that have been used to dealing with institutions, they go immediately into the OTC or the NASDAQ. So we think this is a good opportunity for retail, be that with or without commission, RIA, so that you can do sequential closings. So it's a best efforts underwriting, okay? But you can do a $50 million offering with the first close at 20 and every 5 million thereafter. And you can do it like that. So you're still, and correct me if I misspeak, Andrea, but my understanding is you can do a Title IV Tier 2 offering for less than $20 million. So you get the 50-state blue sky upon issuance.
Right. Sir, you had a question. I'm sorry, I'll get to you next.
I understand that it's not available to companies that are filing their Form 10s. If a company is filing Form 10, they're not trading on a public exchange, and they stop filing that Form 10, can they then file a Reg A?
So they were filing the Form 10, but they stop.
Yes.
They pull it.
Yes, they have to,
then
you have
can
to have a
do it.
cool-off period. Generally, the cool-off period, according to the SEC, is 30 days. 90 days I would feel more comfortable with being non-reporting just because it affects so many other things, like affiliate status. But yeah, there are companies that have been public that have withdrawn, and they are eligible to rely on this exemption.
Oh, go ahead. Follow-up question.
Is there a verification for the investors that no more than 10% of their income and all that, like the 506C?
No, that's a very good question, and I looked into that.
Is there
Oh,
a verification? No, yeah, go ahead.
Yeah, is there a verification for those who are non-accredited where they're only supposed to invest up to 10% of their net asset, their net value, their net worth rather, or income? must the issuer verify that, they're only putting in that percentage? The answer is no. I actually researched it a couple of days ago because I was curious myself. I thought of 506C, where the onus is on the issuer to determine whether someone is truly accredited. That same analogous objective or role is not present here.
Okay.
So signature.
No, a signature on a DNO question, not a DNO, an investor questionnaire is sufficient.
Yeah, okay, Jim? Yeah.
Well, I do, because after we did a Reg A offering, we put together a file which had all the legal documentation, and we know how to run the back office, and it had all the information about investors. FINRA looked at this, and they really liked it, as much as FINRA likes anything. Because of the transparency, the open architecture, the fact that this is a publicly traded security, it didn't have many of the issues that are often associated with private placements and what can be construed as their opaqueness, things of that nature.
Okay, great. And there was a question back here.
Yep. So my first question is on the non-accredited investors. So for the typical accreditation, often they calculate net worth by subtracting the value of one's primary residence. Does the same thing occur for Reg A Plus?
Investors, so,
It's the same definition.
yeah. Yeah, when it comes to accredited investors, it's the same definition.
No, but I mean for the 10, because
Oh.
said
Yeah, it's 5, it is the same definition.
10% of that accredited net worth.
Yeah, sure.
Yes.
Does the FINRA still go through your broker compensation on that?
I'm not sure.
Actually, so
Okay,
the question was,
yes.
does FINRA still go through broker compensation? So about a month ago, FINRA came out with some rulings saying that if a company is engaging a broker-dealer for a Reg A Plus offering, they must also submit information during the process, I mean, whether it's through confidential review or not, on the 1A offering. So they're reviewing the information in conjunction with the SEC as it's going through.
Right, but we have to file on every offering, but in a public offering, they have to give you an approval letter.
Yes, it goes through a FINRA, I think, review process. I'm not sure if it's like a letter that we haven't really seen yet, but there's a guidance, and there's a link somewhere. I would go to finra.org.
Any other questions? Because, oh yeah, please, sir.
Is there a quiet period at all?
Is there a quiet period?
Yes.
No marketing materials allowed?
Oh, so what's interesting about Reg A Plus is there's companies can test the water. So what you have right now, if you Google Reg A Plus and see all these deals are doing, there are a lot of internet online portals that are helping companies go out and market and get sort of these non-binding indication of interest. So companies can go through that test the water process. So if they're not binded to, they're not bound to, sorry, it's not proper grammar. They're not bound to do a Reg A Plus offering, even if they do test the water. But if they were to go through the process, then everything, communication that was used during test the water must be included in their 1A filing.
Okay,
That's
Jim.
very good. What we mean by a quiet period is in our term sheet, we have no trading of the shares for 90 days while the sales are going, because you don't want, for some reason, the shares to be trading at less than your offering price or things of that nature. So until we close the offering, we construe that as a quiet period, no trading in the shares.
Should a research report go out? During that period?
That's a question for counsel, not sure. That's why we have good counsel around us.
Sir.
Are bank holding companies eligible?
Are bank holding companies eligible? And I'm getting the affirmative. Yeah.
Yes, in fact, one of the tier ones that has qualified was a bank that was raising funds for a merger.
All right, any more questions? If not, it's time to discuss the 545 exemption. The 445 exemption. It's 445 and there's a cocktail party. That's the exemption. Thank you very much. I want to thank NIBA. That's funny. And with the show.